Let's now look at the latest financial results from two major players in Nigeria's FMCG sector. I'm talking about Cadbury Nigeria PLC and Unilever Nigeria PLC. Now, both companies have released their 9-month earnings reports for the year 2024, revealing contrasting financial journeys despite facing similar economic challenges. Unilever, on one hand, reported robust revenue growth and managed to improve gross profit margins, though it grapples with rising operational expenses. Meanwhile, we saw Cadbury achieve impressive revenue growth as well, but its performance is marred by escalating finance costs and substantial pre-tax losses. So Vincent Oshoma, securities dealer at Midpoint Capital Limited, joins me to help us understand this better. Thank you so much, Vincent, for joining us.
Thanks for having me.
So let's begin with Unilever. Look at the revenue. It increased by 46% to 103.8 billion naira. Pre-tax profit was up by about 31% rather to about 13.96 billion naira, and the return on equity, was around 13.56%. Now, the share price performance for the year 2024 was around 55.4% year-to-date gain as of what we tracked by October 29. So looking at these results, what do you make of it?
Yeah, it's an impressive result, in spite of the challenges in the economy. To see the company growing both its top line and bottom line, I think is something that is impressive. And from the release of the result, we saw the investors' reaction to the price. We saw an appreciation in the price because when you see companies in the real sector still making such gains despite the challenges in terms of high costs, and also in terms of finance costs, and also the high cost on the consumers. So it's something that is commendable, and definitely investors reacted to the results.
Okay, so we also saw that operating profit margin for the company declined to about 9.8%. So looking at about 13% drop, and our pre-tax profit margin also decreased to about 13.44%. That's about 11% in losses. Should we be worried? And do you think this can be reversed?
Yeah, if you look at the current environment, so it's not surprising. So it's expected that most of the companies in the manufacturing sector will experience a lot of pressures on their operating profits because of the high cost and also the reduction in disposable incomes for a lot of consumers. Definitely, you will continue to see a drop in volume. But the good thing, why they were able to, in terms of their top line, the bottom line, they were able to the bottom line shows that they were able to prevail over the challenges in the fact that you said that they grew their top line revenue. So especially with respect to both their local sales and also exports. So that's something that is commendable for the company. In terms of it being, as we continue to see challenges in the economy, I think we continue to see this kind of result for those companies. But that depends on their ability to improve on their operations and also to be able to overcome these challenges by growing their revenue and also to reduce their costs as much as possible.
Okay, so we also saw that Unilever, gained a bit of forex, despite the fact that we saw fluctuations and some markets, most especially multinationals, closed shop because of the disparity between the naira and the dollar. But they seem to have recorded a bit of gains, according to what we saw. And of course, when you look at the revaluation of the forex, it seems not to have affected them that much. So I'd like to get your thoughts on that, how they're able to glide.
Yeah, recently they divested some of the operation investment to home care and also personal care products. And after that divestment, they talked about the fact that to look at reducing their exposure to foreign exchange. And I think that's what they have done. And the ability to also grow their exports. So that will have led to increase in their foreign exchange income as they reduce their foreign exchange loan exposure. I think that is one of the things that is showing in their results. It has to do with the policy that the company has adopted and also the ability to implement that.
All right, before we close shop on Unilever, we tracked that part of the key expense drivers in 2024 are naira devaluation, inflation, largely driven by economic policies of this administration, and a 10 to 15-year gap for yields and growth has been benchmarked. Now, what do you think of this? Do you see Unilever thriving with its mixed results, as we've seen?
Sorry, I didn't get you.
Yes, I said,
I think it's
are you actually, optimistic? When you look at the results that Unilever has churned out, it's quite mixed. But then, of course, we're talking about key expense drivers in 2024 that have been affected by naira devaluation, inflation, looking at the economic policies of this administration. And for us to hit the yielding curve, the World Bank has come out to say, hey, Nigeria needs about 10 to 15 years for us to hit that benchmark. So looking at the result that Unilever has churned out, do you think it will be able to thrive? Can these results improve before that time, actually?
Yes, if you look at it, one of the major factors you notice in the result is the fact that there has been an increase in exports. So I think they are also taking advantage of the devaluation to also increase their exports, because devaluation, their advantage is the fact that it makes exports cheaper. So with their increase in exports, if they continue to exploit those opportunities in increasing their export volumes and also sales, I think it will help them in overcoming some of the local challenges that they have. And also, like I said, Trey, they have also reduced their exposure to Forex. I think that would significantly reduce help them to overcome the challenges that they are facing locally as we continue to see these challenges increase.
Okay, so let's look at Cadbury PLC now. Quite a relatively different story that we saw with the company. Suffered a pre-tax loss of about 65%, despite a 51% revenue growth. Interestingly, 2023 revenue was around 59.2 billion naira, and this year it decreased to 89.52 billion naira. So, what do you make of Cadbury's results?
Cadbury's results it's quite mixed, because when you look at the top line, it shows you an impressive growth despite the challenges that they have faced, and you can attribute that also to their increase. There's a significant increase in their exports, so that affected the result, and also with their local sales. But the fact that they had a lot of pressures, the challenges in the economy, the increase in finance costs, and also challenges in the economy really affect them. Because when you look at the result, Cadbury, recently there was a restructuring, and from the results you see that they have done a lot to actually turn the fortune from last year, where they recorded a major loss, by having the debt forgiveness and also trying to convert some of those debts to equity, which was actually affected them. We helped them. But when you now look at the position they are currently from where they were at the beginning of the year with respect to Forex, when you look at, we ended the year around less than 1,000 naira to a dollar. And currently we are around 1,600, 1,700. So there has been significant movement in exchange rates. So that also affected them this time around. But when you look at the impact of the exchange, you can see that they actually made significant progress in their operations between last year.
But the company still, suffered pre-tax losses and losses after tax. We're talking about 16.93 billion naira and, of course, 11.85 billion naira. So if we are to look at strategies now, and we're going to be very critical about this, what do you think Cadbury can do in terms of short-term and long-term strategies to actually improve profitability and probably return to sustainable growth?
I think there's some things that are also mainly working against them, which they have less control. When you look at the volatility in Forex and the fact that they are exposed to Forex loans. So I think it has to do with their strategies to reduce their Forex exposure in the current challenging situation, and also look at some backward integration. Because such backward integration will help them to reduce their cost. We're going to see rising costs. So that is the only way as they can also overcome those challenges. And also the opportunities for export that they are currently exploring. I think they are continuing to grow their export volumes. I think that will also help them to increase the revenue, which will help them overcome the challenges that they are facing.
So I haven't posted, a loss of about 13.9 billion naira in pre-tax loss as regards the first half of this year. Do you think that they will be able to exit losses, probably before December?
Yeah, the previous plan was them to exit that, but with the current challenges and also the Forex challenges, is something that they may not be able to do. Depends on how they are able to implement their plan, grow their volumes, because we'll continue to see volatility in the Forex. We thought that when we were at 1,005 levels, that was the peak, but we have seen it move from 1,005 to currently 1,617. If we continue to see this increase, it going to affect this company better to their finance cost. So there's little more than they can do in respect to that, except the reduction in their exposure and also to grow their revenue to take care of this increasing cost.
So talking
they
about
may not be able to meet that reverse the situation completely at the end of the month. They are making significant progress.
Okay.
And if they continue that, you can say
so even as we talk about financial exposure and what the market currently says, we actually saw a surge in their net finance costs. We're talking about 23.18 billion naira, amounting to about 17%, so to speak, and that points to the high finance environment in the country. Now, the federal government keeps talking about single-digit loans to manufacturers and small businesses. I mean, that Cadbury is a very big company, but then we've not really seen impacts in terms of results. Could that be telling on the financial outcome for Cadbury by the end of this year too?
Yes, it's telling for most manufacturers. You see that they continue to complain because the CBN going to see increase in rates, and they have been at the forefront complaining that this could definitely affect the manufacturers and affect jobs in the country. So that's why it's going to show in there. You see a lot of companies because of their exposure. You also saw what happened to Nigerian business in terms of their results. It has to do with the high finance cost environment as well as the forex, the devaluation, the impact is having on companies. It calls for concern because as this company are affected, a lot of jobs definitely are at risk. And also this company, there are companies that have been there. And we have seen exits of a lot of companies from Nigeria, and it has to do with the tough environment that they have to grapple with. And that's it. So the government really need to walk the walk, not just talk about reducing the cost of borrowing. We have to see what them doing a lot to actually see it come to fruition so that this company will be able to be sustainable to survive the challenging times that currently are.
Well, of course, we can't take away from the fact that, these two companies are largely affected by the policies of government. But then one key thing you've actually mentioned is the issue around strategy, and that could just be a buffer for these two companies to stay afloat. Probably, have returns that are actually quite beneficial for them in the long run. Thank you so much, Vincent Oshoma, Securities Dealer at Midpoint Capital Limited, for sharing your thoughts with us.